Gentlemen, welcome back to MGTOW Money. Today's topic, secrets of quickly turning $1,000 into $10,000. Before we get to that, thank you to the ongoing support from the Patreon investors in this channel. Paul, welcome to the MGTOW Money army of Patreon investors in this channel. Men, see the video description today. Become a Patreon investor in this channel. Today's question comes from one of those Patreon investors. This is his second question, Tommy. And by the way, Patreon investors, keep the questions coming in. Tommy's question is, and I'm sort of paraphrasing here, what could I do to turn $1,000 into $10,000 into a few months? And again, I'm sort of paraphrasing what his question was, because specifically his question was about, tell me about futures and options. So for the sake of time, for brevity's sake, I'm going to give all of you men the 20% of what you need to know regarding futures and options that will cover pretty much the 80%, so at least to get you started. This, of course, is a high-level overview. I cannot stress that enough. By the way, I will include in the video description an excellent introductory book to futures and options and sort of getting you started, etc. And furthermore, I should throw out a bias here. This is my personal favorite investment class. I love futures and options, and we'll get into more in the details, etc. Although, frankly, I only dabble in it very occasionally today. All right, so we're going to define futures and options right now in simple terms. Simply, we're talking about bets. In other words, just like you go into a casino, you are making a bet on something, whether it's going to go up in value or going down in value. And that something could be gold, it could be silver, it could be the euro versus the dollar, it could be the euro versus the yen, it could be the dollar versus the Swiss franc, it could be the price of sugar, it could be the price of oil, it could be the price of cocoa. Again, you're making a bet on whether this particular commodity or future is going to rise or fall in value. The most important characteristic that you need to understand regarding futures and options is the term margin. Margin. If you take nothing else from this video, just know if you hear the term futures and options, think about the word margin. So let me give you an example of how margin can work. If you put up $1,000, you can, with margin, and another term you could also use is leverage, but the official term is margin. If you put up $1,000, which effectively is a deposit with the broker, you can control, under some circumstances, for example, $10,000 or $20,000 of that particular investment. So, for example, you could, put up $1,000 and control $10,000 worth of wheat or worth of oats or worth of Bitcoin. Yes, all these things have trade futures and options are available on them. So the other aspect you need to be aware of, again, whether it be futures or options, are that there are time limitations involving them, that there are boundaries. These are trades. There is not a buy and hold in the futures market. There is not a sit it and forget it when it comes to options. These are trades. These are speculations. Again, these are purely 100% bets on the future. It's, again, you're going into the casino, you're betting, is the price of this going to rise or is it going to fall? The only way to make money, by the way, and this is very, very important. If you're attempting to make money here, it's extremely important that you have outstanding, and I would say, dare I say, world-class money management skills when it comes to investing in this investment class. You've got to get your position size right. In other words, you've got to know how much money you're actually putting into this particular commodity, future, whatever you're betting on. You've got to be willing to always, and I can't emphasize that enough, always cut your losses short. And furthermore, you had better have deep pockets. In other words, you're going to inevitably end up with some losses. Some of the most successful futures and commodities and options traders are usually wrong. In other words, they might be wrong 50, 60% of the time on their bets, but because their losses are so low, they will make up for it far more so on the bets that they're correct about. So let's quickly run through a couple of simple examples I think that all of you can relate to. As sort of a slow, easy moving market, typically slow and easy moving, is the corn futures market. Yeah, you know, the stuff that's growing out in Iowa, Nebraska, whatever in the United States. I'm talking about corn. So for example, when I was just looking earlier, if I look at the July 2018 futures corn contract, that's trading at $4.05 per contract, 4.05 per contract. And by the way, a contract of corn represents 5,000 bushels of corn. No, we're not going to be delivering corn to your house. You're not going to end up with 5,000 bushels of corn. Obviously, again, what did I say about trading? This is not a hodler. You're not sitting on these futures that you buy or options that you buy. Okay, so again, you're going to put up, in this particular case, the margin requirement, the good faith deposit, if you will, in this case, is $792. That's it. You put up $792, and they will allow you to control the broker 5,000 bushels of corn. And you say, okay, what's the big deal about that? Okay, well, this is where it gets interesting. For every penny, 1 cent that it moves, so in other words, again, it's at 4.05 right now. If it goes up to 4.06, you've made $50. 50. $50 now is credited to your account. So, simple math, if it's at 405 today, again, on the July contract, and let's just say in 30 days, 45 days, it goes to 455, $4.55. Well, let's see, if I take 50 cents times $50, oh, that's right, I come up with $2,500 US. And remember, I only started out with $792. So I've gone from $792 to $2,500 in a 45-day period. And yes, this does happen on a regular basis, and this type of thing happens on many, many different contracts. Let's go through another example. And this is one very interesting. And again, I'm going to include some slides on this particular one because this is an extremely interesting market today. Today, sugar contracts. The amount of sugar contracts where people are making bets that the price of sugar is going to fall is extremely high. There's a lot of people who, for whatever reason, and I'm sure there's many different reasons, are expecting the price of sugar is going to fall in the near future. There's what's called a heavy short position in sugar. Right now, the sugar contracts require a margin, in other words, again, a deposit from you as a speculator of $1,047. $1,047. Now, if each tick, if you will, each movement in sugar is worth $11.20. So I'm just going to use some simple math here. I looked at a previous chart. A couple of weeks ago, sugar on April the 25th was trading at $10.77. $10.77. Today, it's trading at $11.70. So again, it's moved 93 ticks. So if I take that $11.20 per tick, $11.20 per tick times 93 ticks, it has moved over $1,000 in my favor. So again, I only put up 1,000 and less than 10 days ago, and I'm up over 1,000. So I've doubled my money in less than 10 days on sugar if I had gone long. In other words, if I had placed a bet that sugar is going to rise. Now, with all that said, as fantastic as all that says, I do, of course, need to emphasize there's a disclaimer in this. It goes without saying, this is extremely risky. And with every one of these deposits, again, these margin requirements that they have what's called a margin maintenance requirement. So in other words, without getting into all particulars, if your trade should move against you, in other words, again, let's say that you're long Bitcoin, for example, you think that Bitcoin's going to rise. Put your money where your mouth is. You think Bitcoin's going to rise, so you put some money up and it falls though. And let's just say it only falls $500 per Bitcoin. It can trigger what's called a margin call. In other words, it's hit the margin maintenance level. This is generally, let's just say, 2 or 3 percentage points of where that initial margin level is. So for example, again, simple example, if the margin requirement is $1,000 and the margin maintenance is $950, let's just hypothetically say, if your future should, if your commodity should fall to $950 in terms of its relative value, the broker will call you and require you to put up additional monies to bring it back up to that original level of $1,000 or whatever it might be. And the money has to be supplied immediately, not tomorrow, not in 2 hours. It literally, you've got like 5 to 10 minutes or they'll sell you out of your position and you'll end up losing money. All right, gentlemen, let's quickly summarize here. If you want to make a small fortune trading futures, commodities, that type of thing, awesome. But you'd better start with a large fortune. And that's not a joke here. 95% ballpark of those that trade futures, commodities, options, 95% of people, they lose money in the long run. I didn't say all. You heard what I just said, 95%. The leverage can be a fantastic way to make a lot of money. That's the key to the whole thing. $1 can get you control of $10 worth of assets and just add zeros on the back end of that. $1,000 can get you $10,000 worth of assets or $20,000 worth of assets. And if those things are moving in your favor, you can make a lot of money very, very quickly. Oops. But there's also, of course, the flip side. If it goes against you, you're losing money just as quickly and you'll end up with a margin call and potentially sold out of your position, as has happened to me, and that is a very bad thing. All right, next. This, of course, is only for traders. I can't emphasize enough. This is not for the buy and holders. This is not for the guys who are going to say, I'm going to sit on this for the next 20 years. I'm a buy and hodler, etc. No. Then if that's your ideal personality, if that's your ideal investment, if you want to sit it and forget it, stay out of this market. This is not something for you. And again, obviously, this is very, very risky. Thus, controlling your emotions is absolutely critical. Cutting your losses short is absolutely critical. Getting the position size is so very important. Finally, if you're still interested in options and futures, despite all the disclaimers and warnings that I've thrown out, again, check the video description, read over those particular books. Furthermore, I would recommend there are several different companies that will provide you a sort of a practice account, a play account, etc. With fictitious money. It costs nothing, etc. And at least you can get a feel for trading and seeing how the markets move, etc. And again, there's no risk whatsoever involved in doing this. If nothing else, you might find it rather educational. Gentlemen, hit the like button if you found this useful. As always, John Galt out.